Alright, so this is a window into how I use the trade machine. In this particular example, I'm going to show you what I do when I'm considering taking a bullish position on a company. The first thing I do is I actually customize my deltas. So I go to settings and I put in my deltas. I'm generally not trading in the money options. For single leg strategies, I want to look at the 50, 40, 30, 25, and 20 deltas. So that's at the money and then going to out of the money. And then these are my second legs. Then I just look real basic. I start with owning a long call, doing nothing special with earnings over the last 2 years and trading it weekly. I tend to focus on this 50 delta call. So it looks like if I do nothing special with earnings, I would have made 24.5% over the last 2 years. All right, the next thing I do very quickly is I decide if I want to trade earnings or not. So I go to never trade earnings and I see what happens if I just take the earnings events out. And so we can see a pretty dramatic increase here. We went from a 25% winner to a 70% winner, and I'm taking less risk. Just to make sure that I'm not crazy, sometimes I just click on only trade earnings and I should see negative numbers. Yeah, there it is. So clearly I want to avoid earnings in Apple if I want to buy a weekly call. The next thing I test is my stop losses. When I'm looking at long options, of course, the maximum you can lose when you own an option is 100%. So I look at two stops. I look at 50% and 70%. So I'll put in 50%. This is saying that if the call in any 1 week loses 50% of its value, I just go ahead and sell it and stop trading for that week and start the next week again. So we had a 70% winner last time and now it's 111%. So it definitely looks like cutting these calls off quickly could make us better traders. I'll check 70%. And so this is interesting. A stop loss at 70% is about the same as having no stop loss at all. So it looks like we have found a bit of a sweet spot. So 50% is going to be my stop. And now what I'm going to do, I'll put that back in. Now I just want to test other periods of time to make sure it works. So I'm going to go to 1 year, and we're starting to see these borderline absurd returns because Apple's been ripping in the last year. So 1652%. And just to make sure my stop's doing what I think it should, I'm going to go ahead and take the stop out and see if that 1652% changes. And it actually goes up a little bit in this case, but I'd rather have half the risk and about the same return and something that's worked over a 2-year period than take on that risk. And the last thing I'll do, of course, is I'll look at 6 months, and we can see that obviously it's worked really well. So it's not that I expect to make 400% in the next 6 months on Apple calls. I'm simply getting a feeling for if I want to buy calls in Apple, what it is that I want to do to implement that strategy. In this case, I want to avoid earnings and I want to put a stop loss at 50%, which is a pretty tight stop. All right, the next natural question is, well, if you want to buy calls, try call spreads. So let's just try that. I'm going to clear out my stops, go back to nothing special, and click call spreads. So staying consistent, I'll look at the 50-20 call spread. And here we see a 34% loss. But, remember when we took off earnings last time in Apple, things got better. So, not all hope isn't lost. We'll just go ahead and take off earnings. I went from a negative 34% to a negative 14%, so that's good. Let's try a stop in there, see what happens. We'll put 50%. So now I've got this stop, and it's actually getting a little bit worse, which means that these call spreads actually dip and then come back fairly often. I'll just put a 100% stop in here because remember, call spread is different than owning a call. You can actually lose quite a bit on a call spread. And we see a negative return. So right now what I know is that if I want to play Apple with calls, I know that I want to do it with calls and not call spreads. I know I want a 50% stop, and I know I want to avoid earning. I don't memorize all this. I actually, as I do the test, I'll bring my Excel spreadsheet in. I just write it down. So you don't necessarily have to fill in all of these cells. This was good enough for me. But yeah, it's pretty clear that I'm going to want to own calls rather than call spreads, and I'm going to want to put a 50% stop, and I'm going to want to avoid earnings. And again, it doesn't mean I think I'm going to make 111% or 394%. The point here is not to replicate the past. The point is to use the past to optimize the future. Owning calls with a tight stop has been better than owning call spreads with a stop or without a stop, and avoiding earnings for both has been better. Now I know that, and I'm going to implement that if I want to buy calls. Now, if I'm going to be bullish, I'm also going to check strategies where I'm actually selling premium. So let's go ahead and sell puts and see how that looks. Take off all of our stops. Now when I'm selling options, unlike when I'm buying them, I'm usually looking out of the money, and 30 delta is usually my sweet spot, although I'm willing to look at other places. But this is pretty interesting. It looks like the further out of the money we go, the more profitable we get. So I'm gonna focus on these 30 delta puts and kind of block everything else out. But we're at about a 7% return if we're doing nothing special with earnings. Let's see what happens if we avoid earnings. So now we see that 7% return pop to 14%. So that's good. Now let's go ahead and start implementing some of our stops. I'll put a 50% stop like I did with the calls. Now I see return popping to 25%. Let's see what happens if we put a 70%. So now we're up to 39%, which is pretty good considering we started at 7%. So again, this makes us feel comfortable because we're coming to the same conclusion. If we're going to sell puts in Apple, we're probably going to avoid earnings and we're probably going to put in a stop loss, whether it's 50% or 70%, we're not sure yet. So the next thing I'm going to do is I'm going to keep the stop here. I'm going to go down to 1 year. And as expected, we're seeing a better return. We're seeing 53%. I'm just going to see what would have happened if I turned that 70 stop into a 50. So this is interesting. I'm actually getting a better return with less risk. That is, I'm putting a tighter stop. And the difference wasn't so great in the 2-year test. So this is going to come down to the 6-month test. So we're looking at 23.5% with a 50% stop. And now we're looking at the same thing with a 70% stop. If I'm shorting puts in Apple, I'm going to avoid earnings. I'm going to use a stop loss, but I think I'm actually going to use a 50% stop. Let me just show you. Here are the results. Even though the 70% stop looked better in the 2-year period, it actually looked similar enough in the 1 year and 6-month period, where if I'm going to do this, if I'm going to sell my weekly puts in Apple, I'm actually going to go ahead and put a tighter stop. I've come to the conclusion here that with Apple, again, I'm avoiding earnings and I'm definitely using a stop loss in order to optimize my results. And again, do I expect to make 55% in a year? I don't know, not necessarily. I can't guess where the stock's going to go. What I do know is that in the past, both with calls and with puts, that if I'm skipping earnings and I'm putting in a stop, it's doing better than trading earnings or not putting on a stop. Now, the last thing we'll do is we'll take a look at selling put spreads. So to be consistent with what I was looking at with the short puts, I'm going to look at the 30-10 delta put spread. This is actually one of my favorite back tests of them all. This looks like a really bad trade, right? This is a 40% loser before we do anything. And remember, just selling puts, the 30 delta put was actually a 7% winner before we did anything. This is actually pretty remarkable. Let's go ahead and remove the risk of earnings. So now we see a 33% loser, which is a little bit better than before, but really not that good. And it's pretty easy to just kind of give up right now and say, hey, forget it. I'm not going to look at put spreads. I'm just going to look at short puts. But bear with me. Let's try and put in a stop of 50% and see what happens. So now we've taken the loss down to 8%. Remember, it started at -40, then it went to -33. With the 50% loss is -8. It's still pretty bad, and giving up here feels like the right thing to do, but let me show you what happens when we put in a 100% stop. So remember, when you're short a spread, you can lose much more than 100%. So let's just put a 100% stop. Now all of a sudden we find a 26.8% gain. And just to kind of refresh what happened, we started with a 40% loss, and even when we avoided earnings, we were at a 33% loss. And even at a 50% stop, we were at an 8% loss. Now all of a sudden, we're at a 27% gain. And just to remind you, we were at a 25% gain when we were selling puts. So this is a lower risk strategy because it's a put spread, and we're putting a stop loss, and we're avoiding earnings, and all of a sudden it's looking pretty good. So let's just see how this does over 1 year. Now we're looking at a 105% gain in a year with a put spread that has a stop loss, which is pretty remarkable. And just to make sure we're not crazy, let's just see how this did during earnings. They should be negative, and they are. So avoiding earnings is still the right thing to do. And then just for completeness, we'll go ahead and look at a 6-month test, and we can see we're at a 47% gain. So I'm going to bring my spreadsheet back in here. So just to be clear, this is what we were looking at if we were shorting a put, and this is what we're looking at if we're shorting a put spread. So I'm going to just put them next to each other. We're seeing better returns across the board using a put spread rather than a short put with a stop loss. So what we've decided here is pretty simple. If we're looking to sell premium, we're going to be selling put spreads, we're going to be avoiding earnings, and we're going to be using a stop loss at 100%. If we're going to be trying to get long options, we're going to be buying calls, we're going to be avoiding earnings, and we're going to be using a very tight 50% stop. Call spreads don't work well. Now again, it's not that I expect to make 105% in the next year by selling put spreads in Apple. It's simply that I understand the mechanics of how the stock has behaved in the past. I can't predict what it's going to do in the future, but I do know that using a stop and avoiding earnings across the board has been a better strategy, and I can even go further and tell you exactly what stop has worked the best. This gives me edge ahead of everyone else. So that's it. That's how I approach a long strategy. I look at calls and call spreads, and I look at selling puts and put spreads, and then I look if earnings matter, and I look at stops. Click on the link below to learn more. Thanks for watching.